Most people think loan default is a final collapse. Something loud, something obvious. What's often misunderstood is that default usually happens quietly, long before anything dramatic appears on the surface. Loan default occurs when payments stop and the lender determines that debt is unlikely to be repaid under the original terms. This can happen with personal loans, auto loans, private student loans, or other installment debt. The process begins with missed payments. At first, the loan is marked past due. Fees and interest continue to accrue. Notices are generated automatically. The account status changes internally. As time passes, the loan moves into delinquency. At this stage, the lender may attempt repeated contact, calls, letters, emails. The purpose is documentation as much as recovery. If the account remains unpaid, the lender may declare the loan in default. This is a formal status change. Once defaulted, the original loan agreement is no longer active in the same way. At this point, the full balance may become due immediately. The account may be transferred to a collections department or sold to a third party. Credit reporting often reflects the default status. For secured loans, default can trigger repossession or foreclosure processes. For unsecured loans, the lender may pursue legal action or wage garnishment, depending on the situation and jurisdiction. From the lender's perspective, default is risk resolution. From the system's perspective, it's classification. From the borrower's perspective, it's loss of control. One detail many people don't expect is how long default remains visible. Even after payments resume or the balance is settled, the record of default can persist in credit histories for years. Default doesn't arrive with a single moment. It's the result of accumulated missed deadlines. Once declared, the loan stops being a monthly obligation and becomes a documented failure within financial systems.